Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we've been talking about the markets a little bit because of yesterday, great day in the market, great year in 2019, and now today we're looking to open up sharply lower. I don't know if we're going to get back all the gains from yesterday. It's going to be an interesting day in the markets. Biggest thing for you, I would say, is this. One of the things I want you to understand from these, from these events and to be comfortable with is market risk. If you're invested in the market, you need to understand that about 1 in 4 years are negative years, and it doesn't mean that you're going to have 3 positive and it's going to be a negative. It can run 3 negatives and then a string of 5 or 6 positives, and it can be all over the place. There's no rhyme or reason to that. Just like coming off of a big year, or in 2018, coming off a negative year, to see a big year is not uncommon. Coming off of a big year like this and having a more modest year, also not uncommon. But there are so many different factors. The biggest thing is understanding the importance of staying disciplined, holding course as far as your investments go. But to do that, also making sure that you are invested correctly. All right, I'm going to make it easy, by the way, for some of you. If you're not sure about your portfolios, if you'd like to get a second opinion maybe, or get another look at those, an investment analysis, if you will, of your portfolios, I do that all the time with new clients coming in. If you'd like to have that type of thing done for you at no charge, just call my office. In fact, if you're one of the first 10 callers to my office, I'll do up a comprehensive retirement income analysis. And basically, this is a comprehensive financial plan that looks at not only your portfolios, but all factors, how to minimize taxes, looks at Social Security, answer questions that you may have regarding your Social Security, taxation of Social Security benefits. If you've yet to start taking Social Security, we can help you as far as determining when the best time to take it might be. Talk about Medicare, healthcare costs in retirement at age 65, which you're going to be dealing with the complexities there. And if you're already on Medicare, again, how to, in fact, help cover those costs in retirement. We get into not only the investment side, but we also talk about the whole I can show you your financial future based on the things you're doing and give you an idea of whether you would run out of money. All right, would you be able to attain and maintain your standard of living, quality of life, no matter how long you live, and not have to ever worry about running out of money? This is the kind of planning we do and the strategies we share with you. So I can show you your financial future based on the things you're doing today, and then share strategies with you on how to improve that picture. So it's not just minimizing taxes and maximizing your returns on your investments. It's also about making sure you've got sufficient income from those investments, how to do that in the most tax efficient manner, and understanding in particular with the rules around distributions from IRAs and retirement accounts in general, how that can work as well. We also talk about long-term care and estate planning. It's a comprehensive plan at no charge. If you're one of the first 10 callers, there's the number, 615-376-5325. Tess is standing by. She'll get your information, send you out a checklist of things to bring to your appointment with me to do this planning for you. And when you come in to see me, I'll give you a free copy of my book, 7 Steps to Financial Freedom in Retirement. Don't we want to be financially free to be able to thrive in retirement, not just survive? That's what it's about. It's about having that lifestyle that you desire and being able to never worry about running out of money. And we cover it in the book, as well as, of course, we'll do that kind of planning for you in person when you call the office. All right. One of the things we're talking about before the break was that of longevity. This is one of the biggest risks of all, and the reason, as we're living longer, it magnifies all the other risks, right? If I'm only living for the next 3 to 5 years in retirement, the way it was decades ago, I don't really have to worry too much, right? I mean, inflation, how much are things going to go up in 3 to 5 years? Market risk, how much volatility am I likely to deal with in 3 to 5 years? Interest rate risk, how much are those likely to vary in 3 to 5 years? Much less so. But now when you're talking 15, 20, 25, 30 years maybe in retirement, right? Today, that's that longevity that we're living longer. We're living longer than, meaning are also going to be retired for more years. Now all those things are much bigger risks, much more likely to impact us over our retirement years. So Time magazine back in 2015, in the winter of 2015, we'll show you the cover of Time magazine. It said, here, this baby could live to be 142 years old. Is that amazing? All right, imagine all babies being born today, not just living to 100 or 125, imagine the living to 142. Okay? Now let's take a look. That's pretty impressive to me, and we see a lot of studies showing how this is going to be, and that article goes into it, of course. But let's look at you. If you're a 65-year-old man today, you've got a 50% chance of living to at least 85 and a 30% chance of living till you're 90. If you're a 65-year-old woman, you have a 50% chance of living to age 87 and a 41% chance of living to age 90. And a married couple, right, and you're both 65, 50% chance at least one of you will live to be 91 and a 31% chance that one of you will live to be 95. One of the fastest growing segments of our population, in fact, are centenarians. In other words, people living to be 100, that part of the population, imagine, okay? So what do? Well, that means income in retirement is going to be more important than ever, and not running out, making sure you've got enough. And so what are some of the typical resources, or sources rather, as far as retirement income? One is IRAs, your retirement accounts, or again, 401k, 403b, whatever type of retirement account. Maybe you're a federal employee or military, and you're going to have your thrift savings plan, TSP. And understanding the difference between the Roth TSP and the traditional TSP, and the same thing with regard to 401ks. You've got Roth options with many of those, and of course Roth IRAs, and there's a whole bunch of planning that can go into for tax planning that can go into those kind of strategies. Pensions, shrinking area now. We don't have near as many people with pensions today. I think it's about 20%, give or take, of the workforce will have some form of pension. And from seeing people every day coming into my office and talking about their planning, pensions, one of the things we also see is they're much smaller than they were, say, when our parents were retiring and having pensions then, were much bigger, and of course more of them had it. In fact, between their pensions and Social Security, they were able to live on that typically, and any savings they had was more of a safety net. And understanding that as far as IRAs and retirement plans in general, they've really only been around. I mean, the Tax Revenue Act of 1978 and ERISA back in '74, these were the two legislative acts that brought them into being. It wasn't until the early to mid '80s that they started to take hold. And so if you're looking at it, it's basically just over the last 35 years, and in that time frame, it's more and more have we become dependent upon saving for retirement within these retirement accounts. And again, we see that pensions are gone. The shift has been from pensions, what are defined contribution plans, defined benefit plans rather, with pensions, over to what are called defined contribution plans, which are your 401ks and again 403b, TSP, all of those kind of plans. If maybe you're self-employed, maybe you got a SEP. These same rules all apply. We're going to talk about the distinctions between the plans, but also the similarities. And understanding when it comes to, with pensions being less and less a part of, for most of us, our retirement planning, all the more important that we take care of our savings and our retirement accounts and maximize the returns we're going to get, as well as maximizing or minimizing, we'll say, the taxes to maximize the income. And the way you do so, right, if you're not paying as much in tax on the money you're taking out, that's a great way to make sure your money's going to last in retirement. As you can see here, there are three types of retirement income we just talked about: pensions, your Social Security, and your savings, your different retirement accounts and that. And then you have the difference between, understanding the difference between qualified money and non-qualified money. With qualified money, it's more valuable than non-qualified. And what they mean, the difference between qualified and non-qualified simply means it's either tax qualified, meaning it's either growing tax deferred, like with IRAs and 401ks and the like, or it's growing maybe on a tax deferred and what will be a tax-free basis when you take it out, as in Roth 401ks, Roth TSP, Roth IRAs. So understanding these distinctions, and also non-qualified money then would be just regular savings or investment accounts with money that you've already paid tax on and you're investing, and you're just paying the tax on the interest, dividends, and maybe capital gains as you maybe sell these, from these accounts. So some common questions from baby boomers. This is one of those areas, can you still, understanding how these retirement accounts work, this is stuff I hear all the time. Can I still contribute to a retirement account, and if so, how much? The Secure Act I talked about last week, this is one of those areas where that's changing. Now it's going to be, you're going to be able to still contribute to retirement accounts past the age of 70 and a half, and even past the age of 72, the new RMD age, as long as you have earned income. So what type of retirement account is right for you? Do you want to, is it a Roth account or a traditional account? How are your IRA or 401k withdrawals going to be taxed? When do you take withdrawals, and for how long? When do you take them and how much? All of the different questions you're going to have when it comes to making sure you have sufficient income in retirement. All right, and how to take it from these accounts, minimizing taxes, maximizing returns, getting the most income, and making sure it's going to last as long as possible. All right, we're going to get into more of this when we come back, but first a quick break. Join us here. We'll be right back on the Retirement Report.